In just the last 4 years, we've seen uranium return a staggering 400% from the 2020 pandemic lows to its high in early 2024. This is the Sprott Physical Uranium Trust. This recent move up in uranium has led to a breakout from a 15-year-long basing pattern for this asset. Uranium prices surged, beginning a multi-year rally as you can see here. What caused it? The answer lies in uranium's unique supply and demand dynamics. This chart shows us the global uranium demand since 1945, along with the global uranium production for the same period. Demand was consistently rising until the mid 2000s, driven mostly by uranium's use as fuel for nuclear reactors. And in terms of production, you can see that it had generally been keeping up with demand until the early 1990s, when production started falling off aggressively following the collapse of the Soviet Union, falling below demand in 1991. Meanwhile, demand for uranium continued to grow before tapering off in the mid 2000s and maintaining a relatively stable level of demand since then. So, since 1991, we've been in a uranium supply deficit, meaning uranium supply is below demand. This shortage set the stage for a speculative bubble in the mid 2000s. Global uranium prices went from around $10 in 2003 to a peak of $136 in 2007, before crashing by over 85% over the next 10 years. Now, you might be wondering why uranium prices declined so significantly if there was a supply deficit. And that is because from mid 2000, uranium demand started stagnating, but uranium production started increasingly rising, which was likely a result of higher uranium prices that incentivized more producers. This began turning around the demand and supply dynamics for uranium and making the uranium market less tight, which led to the sharp decline in uranium prices. That is until the mid 2010s, when, as you can see, production peaked. Since then, uranium production has been declining, while demand has remained resilient, even ticking up a little recently, indicating that the supply deficit is potentially building again for the commodity, similar to what we saw in the 1990s. So is this trend likely to persist for uranium? For that, we first have to understand where uranium's demand is coming from. 99% of all the uranium produced in the world is used for one purpose: nuclear reactors. Nuclear power generation grew dramatically from the 1960s onward, stalling out around the mid 2000s. The global leaders in nuclear energy production are the US, China, France, and Russia. Nuclear energy is favored for its reliability, high energy output, and low pollution. It can produce up to 100 times more energy per unit of land compared to renewables like wind and solar, and so is seen by some as a more viable alternative to fossil fuels. However, detractors point to meltdown incidents like what happened at Chernobyl, 3 Mile Island, and Fukushima as reasons to be cautious about nuclear energy. Despite a strong safety record, the stakes are very high. Still, governments and industries around the world are increasingly recognizing the advantages of nuclear power. The shift is clear through the growing number of nuclear reactor projects. For example, the UK aims to quadruple its nuclear capacity by 2050, and India aims to more than triple its capacity by just 2031. So this does suggest that demand for uranium will likely continue to move higher in the coming years. And we can also see the same thing from this chart, showing projected uranium supply in blue and demand in green from 2025 until 2040. Demand is projected to increase throughout this period, likely as a result of more developed and emerging economies turning away from fossil fuels and towards nuclear power for their energy needs. As for supply, uranium production is projected to level off until 2029, before consistently declining for the following decade, which would lead to a massive supply gap like what we saw in the 1990s. This drop in supply would likely result from underinvestment in uranium mining over the past decade, due to low prices and hesitation caused by incidents like Fukushima. Not to mention that new uranium mines take significant investment and up to 10 to 15 years to begin operating. So unless existing mines can ramp up production or inventories can be drawn from, there's generally a significant lag in uranium supply response to changes in demand. All this means the sector is generally unprepared to meet the surging demand from expanding nuclear adoption. It's important to remember, however, that these are just forecasts and not guarantees. It could be that demand ends up picking up slower than projected, or production ramps up quicker than expected, potentially through a new technological development. If these projections do prove accurate, though, it could be the fundamental catalyst needed to drive uranium prices significantly higher than today. You might be wondering, wouldn't extremely high uranium prices crush demand? The answer is not really, because the price of uranium is actually a very small portion of the total cost of generating nuclear power, around 6%. This means that even in a supply squeeze, with uranium prices spiking, demand could continue to remain strong. The biggest cost of generating nuclear power is actually the nuclear power plant investment itself. That requires billions in capital and a lot of time for permitting and construction work. So once these plants are built and operational, they need to, of course, be profitable. And for that, these plants must keep producing energy, regardless of uranium's price, creating a scenario where they will buy uranium at almost any cost to maintain operations. And that's why the upside potential on uranium is significant if we get into that type of scenario. But just because uranium prices are unlikely to affect demand, it doesn't mean that the same holds true for supply. In fact, higher prices can incentivize the price sensitive uranium mines that have been idle to come back into production and supply the commodity to meet the higher demand. This could create a cap on uranium prices as surging supply balances out demand pressures, making the market more balanced from a supply and demand standpoint. In fact, if supply increases too rapidly without demand keeping up, it could cause a further pullback in uranium prices. However, while high uranium prices may theoretically incentivize idle mines to restart and add new supply to enter the market, the reality is far more complex due to significant structural barriers. Years of underinvestment in uranium mining have created a supply chain that is not prepared to respond quickly. Restarting production requires massive capital investment, regulatory approvals, and long lead times, which is exacerbated by stricter environmental and safety standards in today's world. These challenges make uranium's price impact on supply much weaker in the current environment, making it harder for prices to quickly bring supply and demand into balance. Looking at the technical chart of physical uranium, it broke above a significant multi-year long basing pattern in September of 2023, surging by over 100% in under a year. This is actually an inverse head and shoulders pattern. We see a left shoulder here in 2009, a deeper head around the 2020 lows, and a right shoulder in early 2023, all capped by a neckline. With the price of uranium breaking above this neckline, that's a textbook bullish reversal, signaling the end of a 15-year downtrend. Now, we've seen uranium consolidating those gains since the 2020 lows, and the price is currently retesting the neckline. This is a make or break moment. If price holds above this level, the bullish setup remains intact, and we could see another 100% rise in the price of uranium as momentum rebuilds. But if uranium closes below $20, it invalidates the inverse head and shoulders pattern. That wouldn't necessarily spell doom. Prices could still drift sideways or climb more gradually, but it would weaken the technical case for an explosive upside move in the near term. At Capital.com, we'll continue to provide you updates on these market developments. Thank you for watching.